Dr. Derrell Peel.
Good morning. Yeah, it's a pleasure to be here first thing in the morning. Let me go through a bit of the market stuff to kind of set the stage maybe for the rest of the day. You know, it's important that you have in mind, I think you do have in mind very much after the last few months, the backdrop that we're working in. You know, the broader U.S. economy and the global markets, they're always important, but at times they're looming larger on our radar screen than at other times. And I really think they are right now. And in fact, I'll talk about, some of what we've gone through the last few months and in terms of some of the internal things in the cattle industry. But I'll say this right now, going forward, I think probably this external environment is going to be the biggest potential for additional volatility. I'd like to say it's going to go away, that we're not going to have as much volatility. I think there's reasons within the cattle industry why our fundamentals have stabilized a little bit. And we could think of that a little more stability, but these external factors are probably not going to go away. And so, it's been a rough year, and it does have a fairly direct impact on our commodity markets. Obviously, for many months now, we've been talking about a slowdown in China and the implications and the ripple effects that would have around the world. The Japanese economy is still struggling. Brazil's in a recession. There's a number of global things out there that add uncertainty. It comes back into the U.S., in some cases fairly directly. I'll talk about trade a little bit later. But, more somewhat indirect to the cattle industry per se through the stock market, obviously has had a horrible start this year and lots of uncertainty there. Ron mentioned oil prices, and that's a big impact. That affects, broadly speaking, all of our commodity markets. And so that backdrop is there. It's not going to go away. And I think going forward, that's the place you're going to want to keep an eye on. Not that we can do much about that volatility, but to try to get some sense of that. The strong dollar has had a direct impact on our trade. I'll talk about that a little bit later. And while some other things are, coming back, stabilizing, if you will, to a little more normal things, that effect is probably going to continue to be there. So that said, I'm not going to talk any more about that, even though we could spend a lot of time on those factors. Let's move on into the cattle industry per se and talk about, I'm going to talk about the supply side a little bit. We got new inventory numbers about a month ago. We'll talk about that, where we're at on beef production and what to expect. I'll talk a little bit about the demand side for beef, what's going on a bit with the other meats. And how that might impact us. I am going to talk a little bit about the international trade component, which is another one of those things that I think is a little bit more prevalent on our radar screen right now. I'm not going to spend a lot of time talking about feed and input markets and forage conditions because for the first time in a bunch of years, I really don't have to. And that's a good thing. Going forward, we're in better shape. From a drought standpoint and so on, than we've been in a long time, feed prices. So I won't spend much time on that, other than to remind you that can change pretty rapidly too. So we'll take a look at that. So let's start with the big picture here. These are annual average prices, so it takes out a bunch of that short-term volatility, and just look at what happened. And of course, we had this dramatic run-up, and I know we're still reeling from what happened the last 6 months or so. The last part of 2015. That was a big shock. If you'll stop and think about it, it's a different kind of shock. It's a fun shock going up, but it was just as big a shock what happened in 2014. Okay? We knew we were going to push things to levels we'd never seen. We didn't know exactly what that meant, how high it was going to go, nor what the backside of that would look like. So it's been a shock all the way. But you have to recognize that what happened at the end of 2015 was one kind of shock that was kind of paying for the party we had all through 2014 and the first part of 2015. These are annual averages, and if you look at this, it's pretty scary looking because we've got the peak in annual average prices for calves or feeders or fed cattle here. Well, not the fed cattle, but the feeder cattle peaking in 2015 with a sharp drop off to 2016. Okay, that's the scary part. Now, when you break this down to something less than an annual average, these are fourth quarter prices, and so the red line is fourth quarter compared to that annual average. We actually peaked these calf prices in the fall in the fourth quarter of 2014. By the fourth quarter of 2015, we had already made that adjustment. So when you see that annual average, And you say, wow, we got a big drop from 2015 to 2016. Keep in mind, we actually did that at the end of 2015. We're already there, okay? Now we can, and I'll talk a little bit about, how much we should lament what was, briefly, that isn't anymore. And so where we are now is a much different story, and that's really what you want to focus on going forward. We're going to talk about herd numbers continuing to grow, and yes, we're going to put some more pressure on prices, but in a very different way from this point forward than what we've been through the last 6 months. Let me tell you a quick story about how I think you ought to view what happened in 2014 and put it in a little bit of perspective. What happened in December of 2003? What happened? It was a big impact on our cattle industry. That was the first mad cow, right? The cow that stole Christmas. Okay, and most of us with a little jogging now, it's getting to be a few years ago, we remember that. What we sometimes don't remember is that in May of 2003, earlier that year, Canada had their first case of BSE. And as a result of that, the border for Canadian cattle coming into the U.S. was closed for several months. And because of the role they play at the margin and as a source of supply, that caused tremendous shocks to the upside in the U.S. market. So in October of 2003, we saw boxed beef prices at then record levels that we'd never seen before. We saw fed cattle prices at then record levels that we'd never seen before. And I was on a program with the late Paul Hitch about a month after that, November. Feedlots in October of 2003 sold some cattle for a brief period of time, and they were making $250, $300 a head as a result of that shock that was still working its way through the system. And I was on a program with Paul Hitch in November, and he was talking about that, and he said, he says, I got to admit, it was a lot of fun to sell a few pens of cattle and make $300 a head. We've never done that before. That was a lot of fun. But he says, really, I'd like to make $25 a head on every pen I sell for 10 years. I think that's the way you need to look at what happened in 2014, 2015, depending on the timing of when you did stuff, okay? It was fun. It was exhilarating. If you stop and think about it, we know it wasn't sustainable. It wasn't going to last. It was what it was. In some cases, it set us up to have a set of cattle that we're still trying to work our way through now, and that's tough. Those turning points are a real booger. But put that in that perspective and then go forward from here. And from here forward, I think the basic fundamentals of the industry are much more settled down, if you will, in a number of ways. I see some of the indicators in the industry looking more, I hate to use the word normal. I'm not sure there is such a thing as the normal cattle industry, but at least a little more expected. So, fed cattle prices are in the mid 130s. My expectation generally is that we'll probably stay in that 130 range. We're kind of going to move forward here probably to a seasonal peak here in the next few weeks. And then typically we see a summer low. One of the things that I think you can count on now more than you have been able to for the last 2 to 3 years is that we're likely to see some of our more normal seasonality take place. With these markets not trending up or down dramatically, I think we'll see more of our normal patterns. And we're seeing that for the most part this year. Feeder cattle prices, fed cattle prices, cull cow prices are all this spring kind of following a little more what you'd expect seasonally. And in many cases that means some sort of a spring peak. It also probably implies that we'll see some seasonal weakness into the fall for those things. Boxed beef cutout, again, we, after dropping so low late last fall, recovered in January. We've slid back down, but it's started to bounce back as well. We're kind of back on a seasonal pattern there. We're also kind of back to seeing a little bit of this month-to-month cycle of retail buying that tends to cause that thing to behave that way. So cull cow prices, again, did a dramatic adjustment the last part of last year, but given that, are following a more normal seasonal pattern so far. One of the surprises that we didn't know going into everything that happened the last 2 years was how the beef retail prices would hold up. We knew we were going to push them to record levels. We knew we were going to have the tightest supplies of beef we've had in 20 plus years. And what would happen? And the pleasant surprise out of all of that was we pushed retail beef prices to levels we really never dreamed of. It is starting to come down, and it's going to come down some more as we rebuild beef supplies. That doesn't mean that demand is bad. It just means we got more beef to sell, and that's the way the market does that. So, again, all of this is kind of a testament to the fact that, it's clear we've turned the corner. And after getting smaller for most of 20 years, we're now getting bigger. And you can think about the trend that means for the next 2, 3, 4 years, but you can also think about the fact that we haven't been in a market where we're rebuilding, saving a bigger percentage of the heifers on an ongoing basis, at least for another 2 or 3 years. It's a little bit different market environment than we've had in about 20 years. And so there'll be some parts of it that work just a little bit differently than what you'd expect. Here's the numbers we got a month ago from USDA. They're now saying this is where we were in 2015. And relative to that, all cattle and calves up 3.2%, beef cows up 3.5%. That's about 1 million head of cows we added to the beef cow herd last year. And that was what I was expecting. I was using the 3.5% number most of the year in terms of the analysis that I do. Dairy's not changing much. Beef replacement heifers still up 3.3%, suggesting that we're probably not done with expansion, and I think that's true. Cattle on feed, I'll talk about that, what's going on with the dynamics there. And then from the other inventory categories that I don't show here, we calculate an estimated feeder supply, and that was up just under 26 million head on January 1, about a 5.3% increase. Okay, so there's more cattle out there, there's more cattle coming. Here's the Oklahoma numbers, if you're interested. All cattle and calves up 6.6%, cows up nearly 4%, beef replacement heifers 9%, and actually it was this is 2015 revised, an even bigger increase in 2014 to 2015 based on those revisions. Feeder supply is up. In Oklahoma, that's a reflection of the fact that we've had more wheat pasture available and we've got more cattle in the state on January 1 than we've had in a number of years. And our calf crop was up fractionally. For the U.S., I didn't talk about that, but the total calf crop was up about 2.3%. So here's a look at what Oklahoma's beef cow herd has done over the years compared to the national number. And for most of about 20 years, while the national herd was declining, the majority of that time, Oklahoma was growing, on a different scale, of course, until the drought hit. And so the drought brought us down here in 11 and 12, and then we actually started growing in 2013, 2014, more in 2015. We're back to within about 100,000 head of where we were January of 2011 going into the drought. So we've rebounded very aggressively. The heifer number would suggest that we're going to continue to do that. And it's interesting in a way that Oklahoma's rate of growth and recovery from the drought has been significantly faster than what's happened down in Texas, according to the USDA numbers. And of course, there's a bigger chunk of West Texas that's still got more recovery to do, probably too. So maybe that's part of that. So heifers held as beef cow replacements were up sharply in 2015 over 2014, up again in 2016. So again, herd expansion from the standpoint of heifer retention is continuing. We actually started saving a few more heifers as early as 2012. And it didn't translate into much growth because we were still in the drought until starting in 2014 we grew some, and then much more aggressively in 2015. This number of replacement heifers nationally, it's bigger than it was in the mid-2000s when we tried to grow but ultimately did not grow very much. And we're almost at the same level we had back in the early 1990s when we did go through a full-blown herd expansion. That was the last one we did 20 plus years ago. So we're kind of back at that level. And if you look at what's happening here, it's pretty consistent with the kind of pattern that we've seen before in terms of a full-blown herd expansion. We just haven't done it in 20 plus years. In Oklahoma, it's even more dramatic, but the same pattern. Big jump in replacement heifers in 2015, from 2014 to 15, even more in 2016. We're actually at higher levels than we were at either of those two previous expansions or attempted expansions. So again, we've been very aggressive here in Oklahoma. That's just kind of who we are, and we've had the ability with our improved forage conditions to do that. Feeder supplies, this is that 5.3% increase. So it's bigger than the last several years, but it's still a pretty small number by a longer perspective. And so again, it's a testament to the fact that yes, we're getting bigger. There's more cattle coming at us, but it's going to be a somewhat slow process. Okay, it's not happening that dramatically yet. And as we'll see in the feedlot numbers, it really hasn't shown up at the feedlot level yet at all. In Oklahoma, again, you know, we got to very, very low levels because we had nothing for cattle in 13, 14, 15, and then bounced back here some in 2016. Wheat prices, the only reason I put this up here, I don't do wheat, most of you know that. My only point is we do have quite a bit of cattle out on wheat. Some of that there's a choice to be made right now in terms of whether or not we're going to graze out that wheat. I suspect in some cases the disappointing wheat prices we have now may be getting some folks to think about leaving some cattle out on wheat as opposed to pulling it off. And the wheat people tell us that you were at First Hollow Stem down here last week in most cases. It's in northern Oklahoma this week. So it's the time when those decisions have to be made very, very quickly if they haven't already been made. Okay, cattle on feed. For most of last year and so far this year, cattle on feed numbers have stayed pretty flat. Every month we've been able to maintain inventories as big as a year ago. And yet, if you look at placements, this red line is a moving average of feedlot placements. We've continued to place fewer and fewer cattle every month. In the last 6 months, through February 1st, through January, we placed almost 500,000 head less cattle in the feedlots than we did the same period a year ago. Now, how do you have feedlot inventories staying that high when you're placing fewer cattle? Obviously, you're not moving them through very fast, are you? That feedlot inventory is a tank level. Feedlots to me are just a big stock tank. And there's two ways to hold the water level in a stock tank. You can either increase the inflow or you can choke off the outflow. And for over a year, approaching 2 years now, we've been choking off the outflow. Feedlots had an incentive to do that, to slow down, especially last year when feeder cattle prices were so high. Feedlots had a tremendous incentive not to sell cattle very fast because they were going to have to turn around and buy some really expensive cattle with a horrible break-even to replace them. And so we haven't seen that. And what this sets up as far as the feedlot situation is that for the first half of 2016, we're not going to see more cattle coming out of the feedlots. Okay? Now, we might pull those inventories down a little bit if we improve the marketing rate, the turnover rate. But nevertheless, there's not more cattle in there yet. We know they're out there in the feeder supply. So by the second half of the year, certainly we'll start to see this placement pattern increase. There's more cattle out there, and they will eventually show up in the feedlot. And we're going to be into that part of the number side. Our numbers have been down. 2013 was the year that feedlot inventories dropped pretty significantly. A couple of our major feedlots in the state decided not to try to fight that market and just let their inventory slide, and they're slowly rebuilding it. But we're significantly lower than we have been historically as a result of that. The result of everything that happened last year with feedlots was 2015 was the worst year ever for cattle feeding in this country. Feedlots were in a tough situation. Feeder cattle prices were so high there was just no possibility of a break-even that would make sense, a margin potential, even with relatively attractive feed costs. And in fact, relatively cheap feed contributed to the problem because what we did was by the fourth quarter of last year, feedlots took a bad situation and made it worse. And some of what happened to us last fall was a self-inflicted thing because, you know, you can delay marketing cattle for a while. We've got a fairly wide window we can feed cattle in, but at some point they do have to go to town. And we had some cattle that just didn't go to town last fall. We pushed weights extremely high, and so what we did was we took a bad situation and made it worse. One of the things that comes out of all the adjustment we've been through the last 6 months is we have significantly improved that feeder to fed price relationship. It's not quite there yet. Feedlots still don't really have a margin to work with, but it's getting better and it's going to continue to get better as we go forward. At some point, they will have a margin that works. It's an ongoing process. So what we have here is feedlots. This red line is a projected break even. So when it's above the market line, obviously we're losing lots of money. And what we see happening now is that the break evens are falling with the lower feeder prices. At the same time, we're seeing this market kind of stabilize, and they're not together yet. to give you a break-even situation at the feedlots or a positive margin, but we're getting closer, significantly closer than we were just a few months ago. So that's an ongoing process. Cattle slaughter in 2015 was the lowest of this whole thing we've been through for several years. So far this year, cattle slaughter is still down. Again, we're not into bigger numbers yet, certainly not coming out of the feedlot. We're going to get there before the end of the year, and we do expect cattle slaughter by the end of the year to be up 1.5% or something like that. Here's the carcass weight situation again. We've added tremendously to carcass weights the last 2 years, so much so, prior to November of 2014, we had never had average steer carcass weights in this country over 900 pounds. We went over 900 pounds in mid-August last year and stayed there until about 3 weeks ago. Okay, and we actually peaked out last October. November is usually the peak at 930 pounds. We had 15 weeks at the end of 2015 and the first couple of weeks of 2015 when average steer carcass weights in this whole country were bigger than average bull carcass weights by as much as 25 or 30 pounds at times. And actually yesterday's slaughter data for this week, bull carcass weights are only about 5 pounds heavier than steer carcass weights still. Okay, so we have added a lot of weight to offset numbers. Again, feedlots had an incentive to do that. Packers actually had an incentive to let them do it. And we did it for a year without any problems, but we pushed it so far that we did create a wreck last fall that we had to fix. Most of that's kind of out of the system now. I don't think we have a lot of those really burdensome heavyweight cattle out there still. Winter weather also helps take care of that. There's nothing like blizzards in the north to provide some discipline on marketing cattle. So we're probably past most of that, but that contributed to the bigger adjustment or the broader adjustment that was going on last fall. So summing up the supply side, cattle numbers in terms of the beef cow herd started to grow in 2014, aggressively in 2015, probably less aggressively in 2016 as a percentage at least, and with about a 2-year delay, as you would expect, starting in 2016, we'll begin to see beef production grow. And it'll grow, 2016, 2017, and we'll be back up to the levels we were in, say, 2013 and prior to that. It's a process that's going to happen. It's not real fast, but it will happen over time. It depends in part on what we do with these carcass weights. We can get there quicker if we keep making them bigger and bigger, but I think there's a limit to that. So we'll probably see some of that moderate a little bit this year relative to the last 2 years. A little bit on the demand side. Again, we just said that beef production in 2015 was the lowest in 20-something years. It will start to grow by the end of 2016. It's just about unchanged here through the first 2 months of the year. But as we go forward, the combination of carcass weights and eventually beginning to see more cattle come through the system, we expect to see beef production up in that 2.5% range for the year. However, consumers will see only about a 1%, maybe a 0.5 to 1% change in domestic supplies. Okay, and that's a trade adjustment I'll talk about in just a little bit. On the other meats, the pork industry, there's a long story you can tell, but the short of the long story is in 2015, the pork industry planned on a lot of continuing impacts from Ph.D. virus that didn't happen. And so all those extra sows and gilts that they bred had pigs, and they all lived for the most part. And so we had this huge increase in pork production in 2015. And not only that, exports were pretty sluggish, so we had to absorb that in the U.S. market. We're working through the tail end of that big bulge of pork supplies right now through the first quarter here. And then for the rest of the year, much more modest rate of growth and expectations for more exports means that net pork supplies in the U.S. from a consumer standpoint may actually get smaller this year. So less impact, relatively speaking, from the pork side than, say, last year. On the broiler side, different story, but a similar kind of theme, a disease impact. We had about a 4% increase in production last year, but because of avian influenza in the first half of 2015, we exported significantly less broiler meat than we normally do, had to absorb that in the domestic market, so that put a lot of poultry supplies on top of a lot of pork supplies in the market. This year, a more modest rate of growth in broiler production. In fact, that may fall even more here. It's not quite clear yet. And fingers crossed, no more outbreaks of avian influenza. We had a scare 3 weeks ago now up in Indiana. Looks like that one's going to get past. It could happen again, but if it doesn't happen and we see broiler exports recover like we expect with no additional disease problems, then the net increase in broiler supplies in 2016 will be, again, very modest, 0.5% or something like that. So the take-home message here is that total meat production will be higher in 2016, and for the first time in several years, a bigger proportion of that growth will be on the beef side. But when you account for the trade adjustments, total domestic supplies of beef from a consumer standpoint actually they're going to increase, but very slightly. Actually, maybe almost unchanged from a year ago. So not so much pressure there. Beef consumption has been declining for a number of years, okay? And sometimes I still see this in various reports that means beef demand has gotten worse, okay? Beef demand has not gotten worse. The reason beef consumption has gone down over the last several years is because we haven't produced as much beef. Per capita consumption is just another way to measure supply. If you don't produce it, you can't eat it, okay? You don't know anything about demand until you talk about price levels that you trade this beef at. Beef per capita consumption is going to start to grow because we're going to start growing the production of beef. Just quickly, I wanted to show you several wholesale charts, and I have one quick message here. I'm not going to talk about these. There's ribeyes above year-ago levels. Loin strips a little bit lower, but pretty close to year-ago levels. Tenderloins running just about the same as year ago. So those middle meats are running about the same as a year ago. If you look at chucks were all over the place last year. Extremely volatile. We're running a little below that. If you look at rounds, significantly below. If you look at the trimmings, this is the lean trimmings, so cow beef basically, well below year-ago levels. 50% trimmings, the fatty trimmings off our fed cattle, below a year ago. What's the message here? Right now, for the first time in several years, the middle meats are stronger than the end meats. For the last several years, the end meats have kind of carried the market and we've struggled with our middle meats. So we're kind of seeing that change in the profile of demand a little bit, kind of back to what we would normally expect with the middle meats carrying a bigger proportion of that. So it's another thing to keep in mind. It's another sign to me that this market is somewhat returning to whatever the heck normal is, something like normal. Here's the best measure I have, or at least a quick measure of beef demand. I talked about the fact that we had lots of pork supply, lots of poultry supply in 2015, and yet through most of the year, beef prices at the consumer level, at the retail level, continue to climb relative to those other meats. We set all kinds of new records. This red line up here is the ratio of retail beef prices to retail broiler prices. It has peaked, like the retail beef price series. It has peaked and it is going to come down, but again, it was unexpected and a very pleasant surprise that beef was able to continue to price at higher and higher levels despite the relative availability of pork and poultry over the last 2 years. The beef to pork ratio has also been at record levels. And again, they've peaked, they're going to work their way down, but we're in pretty good shape from a demand standpoint and have been all through this. As beef prices come down, the challenge now is for the beef industry to pull back in some of those consumers that did get priced out of the market. We didn't have enough beef for everybody for the last 2 years. We found out who wanted it the most and they were willing to pay for it. That's what markets are supposed to do. As the supply grows, the price will come down and now we're going to try to pull more people back in. So that's sort of the next demand challenge, but there's no real indication that we need to be very worried about that. We do have to keep an eye on it as we go forward. Okay, I'm going to wrap up here with a few slides on international trade. I just pulled in one exchange rate chart. I look at several of them. You can look at the general dollar index and you get the same picture. I oftentimes look specifically at currencies that are directly affecting beef imports or exports or cattle trade. So I pulled in this chart that shows the Mexican peso relative to the US dollar because that's a good example of all three of those things. We import cattle from them, we export beef to them, we also import beef from them. And so you look at these impacts, and of course from mid-2014 through the end of 2015, a fairly serious erosion in the value of the peso to the US dollar. So, you know, if you look at the last few months of 2015, the erosion in the value of the peso makes it extremely difficult for us to sell. If they got to buy dollars to buy U.S. beef in dollar terms, it takes more pesos to do that. It's tough to sell U.S. beef down there because it takes a lot of pesos to get that meat, and it also actually offset some of the decrease in cattle prices in the U.S. The erosion in the peso in Mexico made the 25 to 30% drop in U.S. cattle prices only about a 10% drop, something like that. Okay? The point is, it has an impact, and we're going to continue to struggle with that in terms of, again, you know, the Mexican peso, the Canadian dollar, the Australian dollar, the Japanese yen, all of those currencies where we're involved in trade with those countries. So here's the top 5 beef export markets at the current time. For 2015, we had a net at the end of the year of about a 12% decrease in exports. Beef was expensive most of the year, and a strong dollar made it harder. By the end of the year, it's not quite as dramatic. We were starting to moderate, and actually you can sort of see that. Beef exports in 2015, through much of the year, were well below year earlier levels, but by the end of the year, beginning to moderate, stabilize a little bit. We don't expect to see much growth in exports this year. In fact, they may drop a little bit farther, but really kind of stabilizing in 2016. Okay, so that's the way to think about it. Beef exports probably stabilizing. Our prices will be coming down. There'll be somewhat less price pressure, but the exchange rate effect will still be a headwind for us in terms of exports. On the import side, again, there's the top 5 current import markets. And these do change. Some of these bounce around from year to year. About a 14% increase in imports last year, following about a 30% increase in 2014. Again, record high U.S. prices and a strong dollar makes the U.S. market very attractive to anybody that's in a position to send us meat. But notice, compared to this annual increase, by the month of December alone, we were down 35% year over year. So that's starting to change. We went from being up year over year every month through October, and by November and December, actually in October a little bit, and November and December starting to drop off. We expect that to continue. A big chunk of those imports have come from Australia the last 2 years because they've been in a drought and liquidating cattle, and they won't continue to do that. And so we expect to see significantly smaller imports from Australia, perhaps a couple of the other suppliers, and the net effect is that we're looking for, after a spike in 2015, moderation in those imports this year and going forward. And again, depending on what the exchange rate does for the dollar, that could be a faster or slower pace. But probably in any event, we'll see that moderation happen in imports. Same effect, cattle from Mexico. We wound up with about just under 4% increase year over year. All of that happened in the first part of the year. By the last 2 months of the year, we were down significantly. Numbers are tight there. And so we'll probably see less cattle coming from Mexico this year. We already are seeing less cattle coming from Canada because both of those countries are really in the position of herd rebuilding now. And if the drought in Australia breaks, they'll be in herd rebuilding. We could see significant tightness of cattle numbers really on a global scale, at least in those major countries, as a result of that. So I'm going to wrap up back here where we started. The market got increasingly desperate to increase cow numbers. We got smaller than we ever intended to do. All of the cattle herd liquidation, really from about 2002 through 2013, was not stuff we really intended to do. It was various shocks, then the drought that pushed us down to those levels. And so the market got increasingly concerned about jump-starting that. And so, you know, cow-calf producers were the target of that because they're the source of supply. So in 2014, yes, we had these $500 a head cow returns. That was fantastic. It was a lot of fun. If it was that easy, everybody in the world would be in the cow-calf business, and then that'd tear it up anyway, right? So it's not going to work, and you can't expect that. We still got pretty good prices and pretty good opportunities for returns. For another 2 or 3 years, we know the trend is there. We're going to pressure these prices, and we're going to have to go back and actually worry about costs a little bit. Okay, I'm being a little bit smart aleck, but you know, we really do. But there's still an opportunity for some decent returns. We got to put a little more emphasis on managing those returns. But at the cow-calf level, you know, the rest of the feeder cattle, the stocker level and the fed cattle markets are still trying to get margins back into some sort of balance that works, and that's not quite done yet, but getting closer. And so I think you can take where we are today with these markets, recognizing that there's a trend down, but significantly different than what we've been through the last few months, and you can sort of think about how to play out the next couple of years. You know, we're going to see herd expansion for at least 2016 and 2017, possibly even still into 2018. We don't know yet how big we need to be as an industry from the standpoint of cow numbers. It's going to depend on things that happen along the way in terms of domestic markets and international markets. And it also depends on how we translate cattle numbers in terms of a calf crop into pounds of beef. So what happens with carcass weights will matter too. So we got to keep an eye on those things. But there's an opportunity going forward with a little bit more stability in a relative sense, subject to all of that external volatility that we started off talking about. I don't think that's going to go away. Thank you very much.
All right, thanks, Derrell.